Good morning, traders and investors. This is Roger Scott, Senior Strategist for Wealth Press. Today's Thursday. It's March 9th. March is what, almost a third over? I mean, this quarter is almost done. Can you imagine the first quarter of 2023 is almost behind us? It's about 7:45 in the morning, as you could see right here on my screen. The market's not going to open up for another hour and 45 minutes, so we have plenty of time to get things going. I'm doing these a little earlier to benefit you. And by the way, please subscribe to our videos, like our channel, and comment below. It drives me to give you more content. It drives me to answer more questions. It opens up cans of worms that are sometimes very, very helpful for our analysis. So don't be afraid to post a comment in the YouTube channel. We use those comments for feedback too. So very, very important. Today, we're looking to be opening down a bit. This is randomness. This is not a big market mover. And I am sort of slightly encouraged by the fact that the bond market, the 10-year, did not drop from the sky. This trading action right here that we're seeing, this kind of choppiness right here, this is indicative of more chop in the Dow Jones, as you can see right here. The Dow Jones is only down 12 cents right now. But if we can rally, if we can not break the slow and rally higher, there's a really good chance we're going to go back up to the base. I think this market's actually doing everything humanly possible to try to scare the living pants out of us and thinking we're going to go below the 200-day moving average. But with the chop we're seeing over the last several months, and with support being at these levels, I think it'll be able to hold, especially with earnings behind us. Mr. Jerome, let me lie to you some more and try to confuse you. Powell speaking. So I'm thinking it'll hold because the bond market's holding, because we're getting some acceleration from some sectors, which I'm going to talk about in a minute, and because generally speaking, the market is a lot more choppier now than it was several months ago. And volatility, I want to show you something else that's also pointing towards a choppy market. That's the ATR. I want to show you. This is an indicator called ATR. This indicator measures volatility. It doesn't tell you anything about market direction. It just measures volatility. And as you can see here, volatility is at the lowest level. Let's see how far back. Volatility now is the lowest level we've seen since summer of 2022, when the market was right here. But remember, the market is not moving directionally like this now. And you would see volatility goes down when the market goes up, and volatility goes up when the market goes down. But we're so choppy right now, it's very, very, very low volatility. So my point here is volatility could revert, but volatility was really, really high for a while. So there's going to be two scenarios. Either we're going to continue staying choppy. There's very little odds of us going higher right now. I'm going to repeat that. There's very, very little odds of us going higher, but volatility lower means we could be in this chop shop for quite some time. I mean, look at this. That's chop shop on the Dow. And I'm using the Dow because it's just the best representation of the broad market right now, because it is the large caps and it is giving us a very choppy market. If you look at the S&P 500, you see it also started getting choppy, but it had a little more directional bias. But again, let me just show you this. Chop shop. Look. Chop shop. Just choppy, non-directional. But I'll tell you the truth, that's not the worst thing for the market in this type of an environment. It really isn't. We can even take this up here. So the bottom line is, I think we're just going to stay in this little range for a while, which may not be the worst thing in the world. It's a lot better than us dropping. Remember something else. The longer we can maintain choppiness or consolidation, the better the odds that the economy will actually turn positive and we won't go down. But the fact that all of this negative news that the Fed may be increasing rates, and the fact that the market held on and the bond market held on, is actually fairly positive. And no, I'm not trying to trick you into thinking the market's going bullish. I just don't think the market is as bearish as the sentiment appears to have been in the last couple of weeks. In terms of data, we've got jobless claims and we've got natural gas, and I'll talk about more. Tomorrow, the big report comes. This jobless claim, it's been the most steadiest indicator since we started doing this years and years ago. It's been holding right around to 200,000. I think the moving average is like 200,000, 193,000. It's the same thing every week. So if you start hearing stories about how the market's being influenced by the jobless claims, it's not. Maybe the employment situation, because this thing has been coming up right. Look at this, 193, 205, right in that ballpark. So I'm not seeing anything major there. Now let's talk about the economy a little bit and see what's on the table, and then we'll jump into sectors. Remember, today's Thursday. I give you my top ETF and option picks, and I want to do some momentum studies in a minute. So 3 major benchmarks closed the regular session mixed, choppy, without any bias. And again, that's after Mr. Grim Reaper Powell. That's what I'm going to call him from now on. Mr. Grim Powell Reaper had a lot of negative things to say. Not really negative, but to be honest with you, what he said wasn't surprising. What I was surprised was that on February 7th, here, let me show you something. I want to show you this. This rascal. Powell did... Here, disinflation. Here, look. February 7th, a month and 2 days ago. Disinflation process has begun. See, you just can't trust this guy. You just can't trust him. It's right there. It's a quote. I thought I was losing my mind, but he did say it. And he completely took it back. Like it never happened. It's really amazing, all right? And nobody's calling him on it. By the way, meanwhile, all the other Feds and Christine Lagarde have been saying what he just said recently, not what he said on February 7th, that we've got more to go. He's just all over the place. Don't get me started on Powell. So Fed Chair Powell reiterated his hawkish message on pace and duration of higher interest rates in his second day of testimony. The first one wasn't enough. At the same time, Powell emphasized no decision has been made on the pace of interest rate hikes ahead of the central bank's meeting in March, as it would depend on upcoming economic data. I stress that no decision has been made. Yeah, really, tell that to the bond market. Look at the bond market. 76% chance of a 50 basis point rate hike. So the market's ready for you, Powell. It's ready, and it's already priced in. Data on Wednesday showed that U.S. ADP, that's the private report, came in at 242,000, above expectations of 200,000, indicating continuous resilience in the market. But let's see what the Friday's number says, and let's see if it confirms. In addition, U.S. jobs openings fell less than expected to 10.824 million in January. Data from December was revised upwards. As I mentioned, all eyes today on the jobless claims. I'm not really expecting anything crazy. We haven't seen anything crazy. It's been really steady. Honestly, it's been the most accurate and the most like non-eventful indicator we've seen all year, which just kind of blows my mind away, because you would think jobless claims would, pick up, but this has been straight from like Wizard of Oz this year, last couple of years. European stocks have received negative hangover from Wall Street and Asia from main indexes. It's called handover, but I call it hangover after main indexes closed mixed on Fed fears and soft China inflation data. Now, we're not hearing anything from China in terms of COVID, but what we are hearing finally is that things are picking up slower than expected. That's a major issue, and that will impact U.S. economy. There's no way it can't. It would be virtually impossible. China's Shanghai Composite closed lower after consumer inflation data for February was softer than expected, while producer inflation deteriorated more than expected in February, as spending failed to elevate after the country eased its severe COVID curves. Hey, it's going to be slow. I mean, 3 years they were closed. They're not just going to pick up like that. It doesn't work that way. All right. Same time, Japan, look at this 6-month high. You know what they're doing? They're keeping their head down and they're pretending none of this is happening, and they're waiting to see what Japan is doing. They're waiting for the rest of the world to pick up the pace, and then they're going to get a little tougher. Now, you can't do that if you're US or China, because those economies are big, but you can do that in Japan right now because it's the third. So they're actually waiting for everybody else to start picking things up, and then they're going to start increasing policy. Now, can I say that's a bad decision? Honestly, if I had that option, I would probably do that too. But US can't do that. We already tried that once during COVID. It didn't work very well for us. But Japan may be able to get away with it. It's actually really interesting. I kind of like what they're doing. They're being very sneaky. Not really, maybe a little passive, not passive aggressive, but a little passive. But I like it. Hyatt has dropped 1% in pre-market trading after Barclays downgraded the stock. Now, I'm really concerned about, not Hyatt, but I'm really concerned about what they're saying, because I'm expecting hotels, casinos, airlines to actually continue picking up, and they're looking good. So I'm hoping, and I will check this news, but I'm hoping that it's very specific to Hyatt hotels and it's not a broad downgrade. We do have some interesting earnings today. DocuSign, Oracle. Oracle, this used to be the Tesla of the 90s. Oracle was one of the biggest stocks. JD's reporting. That's a Chinese stock. Ulta Beauty, for all of you beauty fans out there, that's a chain here in Florida, and they do really well when COVID is not happening. Gap is reporting today. A couple of trinkets, nothing major, but a couple of trinkets. So that's what we got there. Now, let's talk a little bit about sectors, since today's Thursday, and Thursday, Uncle Roger likes to give you his sectors. So as you could see here, there's no denying. Look at the strength. Industrial, energy, basic materials. Remember when energy went all the way down and I said it's not going to hold? And I think the same thing for utilities. Now let me show you something. Let me show you this. This is important. We gotta watch this. If you look at momentum levels right now, you will see. Look at consumer staples. They're 24 versus 52. 52% of stocks are trading above the 50-day moving average. That's telling me that this might have bottomed out. And by the way, we've been below the current level on consumer staples once, twice, 3 times. Why do you think I bought KHC yesterday? I think I bought KHC yesterday. I know we bought a consumer staple stocks. It was either Heinz or something like that. But we did get one for Sniper yesterday. But I think consumer staples are turning around. Another sector that I think has bottomed out, let me show you this, is utilities. I think utilities have bottomed out. So utilities and consumer staples, I'm really liking right now a lot because I don't think they have much more to go. And utilities, I mean, look, 10%, 17%. Let's just take a look at this for the heck of it. I mean, look at that. Look at that. We're real low. So I'm really liking utilities right now. And utilities shouldn't be this low in light of the fact that we're seeing inflation. I think the same thing happened to utilities as what happened with energies. It had a short-term shakeout. So look at healthcare also, 20%. Take a look at this. Take a look at these levels. Healthcare looks like it's bottoming out, doesn't have much more to go. But look at now at consumer staples. I mean, communication, sorry. Could go quite more. Look at technology. Let me show you technology. Oh, consumer discretionary. Let's look at that. Looks like it's got more to go. Looks like it's got more to go. And technology, let me show you, also looks like it's got more to go. Whenever they reach these levels, so we're kind of in between on them. Now, what's interesting is if you look at technology, where is it? It's right here. Now, there's no business for technology and communication services to be here right now and consumer discretionary to be down there. In my opinion, what I think is going to happen is we're going to see healthcare, consumer staples, and possibly financial come up, and technology communication services become friends with consumer discretionary. I also think utilities are going to come up. Now, technically, let's look at it technically. I like industrial right now. I like it. I mean, I'm a huge fan of industrial stocks right now. Again, technology, we got to be careful because it didn't take this high. See, look at industrial. It took out the high, or it matched that high. That's huge. It made a higher high. Technology, it did not. Let's see some other ones. Communication services clearly did not. Consumer discretionary clearly did not. And if you guys think that technology is going to rally while communication services is going to go down and consumer discretionary is going to go down, let me sell you some ice in Alaska. They're so correlated. It would be virtually impossible. They're all completely related to each other. Facebook, Apple, is it consumer discretionary? Is it technology? So you got to be careful. Consumer staples, on the other hand, I think are bottoming out. I think healthcare is near bottoming out. I think utilities are bottoming out. I think real estate's going to stay choppy, but I'm very, very uncertain right now with what I'm seeing with consumer discretionary, with communication services, and technology. Be very careful. Now, if technology starts breaking high, it breaks above this level, that'll be a different story. Energy is also looking pretty good, but not as good as industrial. So if I was a betting man, if I wanted a good stock right now, I would be looking at XLI. And let me look at XLI right now as we speak. XLI. Whoops. XLI right here. Ooh, look at this trend. I like this trend. And I would be looking at options, and I would probably go out to about 44 days, probably enough time right now. You don't want to be in here more than 10 days. And they're not that expensive. You could probably get a 103 later today when the market opens with a tight spread. But I would be looking at the 102 to 104, around this territory that expires in, what is this, January, February, March, April, in April. I mean, you can go a little further. You can go to 7. I would actually prefer, honestly, I would probably prefer May. And there's plenty of open interest, but you'll pay a little more. But you'll have a lot better, you'll have a lot less decay than you would have otherwise. And if you want to pick bottoms right now, and I think right now may be a good time, I would actually go with utilities. I really like utilities, and I think they've bottomed out right now. And let me show you. Let me actually look at the chart of utilities. Look at the 10-year chart of utilities on a monthly basis, right at the 50-day line. Let's look at weekly. Weekly, right at the 200-day moving average. Let's look at daily. Yeah, it looks like it could be bottom here, and we're very close to the bottom too. Yeah, it doesn't look like it's got more to go. It looks like it wants to come up right now. So utilities would be like my bargain hunt, all right? And for that one, I would definitely go to May, January, February, March, April. Yeah, May. My months are all over the place, and you could definitely find some open interest there. You can go to the 67. Remember, you got to wait for these things to open. They'll get really, really tight. There's plenty of open interest and volume. So utilities and industrial stocks. Boring. You want to be boring right now. Boring and safe is the way to go. Now, folks, before I let you go, boy, I'm just going all over the place. So industrial stocks and utility stocks. Don't go crazy on utilities, but I really like industrial. Utilities could be bottoming, but I like industrial. It's making higher highs. Now, folks, something shocking is happening on Wall Street, and it could result in the biggest cash flood on record in the U.S. stock market. That's right. This cash flood could cause a profit surge likes of which we have not seen in a long time. There's a lot of money on the sidelines right now, and they're putting their money in bonds, in corporate bonds, in dividend stocks. Nobody's putting their money in growth or even defensive stocks right now. There was too much risk. But I think we're getting closer because the market is not reacting negatively when Powell speaks nearly as much as I thought it would. And earnings are behind us, and most of everything is known. And even China's coming out of this thing, and a lot of fund stocks are starting to break out, which I've been talking about lately. So there's a lot of money on the sidelines. And by the way, small caps like ARK, they were not bothered by what happened with Powell. Now, remember, these stocks were the weakest stocks. Look, nothing. So there's a little silver lining here. Follow the link below. I'm going to show you where the money is likely to end up. There's billions and trillions of dollars, and this cash flood could really come in. I want to show you which stocks, how to find the right stocks, how to pick the right sectors, and I'll even give you a freebie. And one of them is an airline stock that I'm liking right now. Follow the link below. Check it out. If you don't know where the link is, go to YouTube Wealth Press channel. It's there. And the Telegram subscription is there too. Now, we've been giving some bonus trades on seasonality on Telegram, so you want to subscribe there too. Post comments, feedback, like this channel, and I'll talk to you tomorrow. If you have any questions, support@marketgeeks.com. Bye, guys. Have a great, great day.